Did you know that you can now get 4 free stocks with Robinhood? If you're not already signed up for Robinhood, use the link down below. You don't even have to deposit any money, just link your bank account. They will give you 1 free stock within 24 hours and an additional 3 totally free stocks by February 1st. Just make sure you sign up before the end of January 31st. Use that link down below. It is a special creator-only promo. Hey everyone, me Kevin here. We need to talk about a GameStop. What the heck is happening and what's to come? I'm going to provide a quick summary of what the heck is happening, and most importantly, I want to talk about what is to come, not only for GameStop and stocks like AMC, but also, are we missing a hidden opportunity, a potential silent market crash that we could be taking advantage of? Or is it even blasphemous to suggest that we potentially consider looking at something other than GameStop? After all, diamond hands, hodl GameStop and ride the rocket ship to the moon. It's got a current price target of $420.69. Hey, and you know what? We might blow right past that. Up to $1,000 a share, some say. After all, you've got people like Deep Effing Value on Reddit's Wall Street Bets forum betting $50,000 as a YOLO and turning that into now $47.9 million. And if DFV is holding, well then we can hold as well. So here are my thoughts on the entire situation. First, a quick summary on what's happening. Take basically any shorted stock in 2021 and you're pretty much up. In fact, the top 50 most shorted stocks in 2021 are up on average 33%. But of course, if you zoom in a little bit, you'll find companies like GameStop and AMC, which are up over quadruple in just the last few days. You've got Express, which has 7 to 8x in just the last few days. You've got, wait for it, Blockbuster liquidations up a substantial amount, over 150% in a day. Nokia, BlackBerry, the National Beverage Corporation, aka Fizz, ticker symbol Fizz. All of these companies up substantially. And what do all of these companies have in common? Well, they're all companies that the market had basically decided you're dead. So we're going to short you to oblivion. Shorting a stock is basically placing a bet against the stock, that these stocks are going to fail. Yet in a very David versus Goliath situation, you have a community of ordinary investors gathered together on the Wall Street Bets subreddit of reddit.com, making bullish predictions that no, the Fed's money printer is spinning too fast, and these companies actually have really good fundamentals that can get blown back to life with the help and support of the money printer, yes, but also strong fundamentals. And these companies will not go bankrupt. In fact, it was Jerome Powell himself who today said that we have been able to avoid a substantial amount of corporate bankruptcies because we've been able to get through a lot of this pandemic, and we are hopefully soon done with this pandemic, and we can see a nice surge in spending again. This is leading people to really follow the belief of people like co-founder Ryan Cohen of the company Chewy. Chewy sells products online. Ryan Cohen ended up joining the board of directors at GameStop and says, hey, you know, people are buying a lot of stuff online, but guess what you can't do online? You can't try a game before you buy it. At least that's Ryan Cohen's argument. And this is just, of course, one of his arguments. I'm oversimplifying here, but Ryan Cohen suggests, hey, you know, look, GameStop, Toys R Us is gone. Best Buy's products barely work when you go to try a game out in person. You know, every time I go to a Best Buy, it seems like you can't actually try the game out in person. But you go to a GameStop, you can actually play the game in person. In fact, I have vivid memories of going to an elite Call of Duty tournament at a GameStop. I won't mention how well I did because that would be embarrassing for somebody in this video. But anyway, the point is, GameStop has not only been a source of nostalgia for a lot of us, but it is something that we believe, or many of us fundamentally believe, deserves a place in the 2021 to 2030 future. It is not a company we want to see go bankrupt. Well, as a result of not wanting to see these companies go bankrupt, finding fundamental vision for the companies, but also realizing that there are massive short positions outstanding against these companies, Wall Street Bets has found a way to maybe crank the money printer for ordinary Americans once and for all. After all, it seems like the money printer only helps rich corporate executives and corporations, which are supposed to trickle money down back to the average American Joe. But now, we as Americans have been able to, turn the tables a little bit against corporate greed. In fact, when we talk about corporate greed, we're specifically talking about hedge fund greed. And this has to do with setting up the basis for a potential short squeeze. See, the easiest thing to do here is just quickly explain what a short squeeze is and what's going on in my words, because there is a lot of information that people forget. Because remember, when you short a stock, in order for there to be a short squeeze, you actually have to be forced out of that position. Why would anybody who's losing money on a stock not just hold on? Why would they get squeezed out of a position? Well, let's understand that because Wall Street Bets has nailed the opportunity to find greedy hedge funds who are mega shorting stocks and squeeze them right out of their positions to transfer wealth from the rich to the average American. So here's how this process works. Let's say you are an individual investor and you decide, you know what, I think GameStop, ticker symbol GME, is going to go bankrupt. I think they're going to zero. And let's say the share is trading for around $20 a share. Well, what you can do is you can say to a company like a TD Ameritrade or Webull or whatever, I want to borrow shares at $20 per share. Then you get the shares, and now you owe $20, of course, but you have a $20 share. You can now sell the share at $20. And let's say you do that 1,000 times. Well, you have now sold those 1,000 shares, so you have $20,000 in cash in your brokerage account, but you also have $20,000 of debt. So the moment you begin your short position, you are actually equal. You have $20,000 of debt and $20,000 of cash. Now, here's how you make money. If GameStop does end up going down from, let's say, $20 to $5, then what you could do as a short seller is you can just buy the stocks on the public market at market value, aka $5 per share, times 1,000 shares, that's $5,000, so it costs you $5,000 to get those 1,000 shares back. And now all of a sudden, you have profited $15,000. Because remember, you had $20,000 of cash and you had $20,000 of debt, and that is your obligation to rebuy those shares at some point in the future. But because the value of your debt actually changes with the value of the stock, and the value of your debt when the stock goes down is only $5,000, hey, you can make that trade and cash out 15 grand. That's really, really important. Now, what we're going to do is we're just going to erase this and scroll down so it's out of our way and we can understand what happens when things don't go the good way. All right, let's understand. What happens if GameStop goes up to $100 per share? Well, now you have to buy 1,000 shares. Well, I forgot a zero there. There we go. 1,000 shares at $100 a piece, which is $100,000. So this means you're sitting there with your brokerage account at $20,000 of cash, but now you have debt that has actually gone up in value, and you have an obligation to cover $100,000 of debt. This means right now you are 5x in debt compared to the cash you have. That's not good. Brokerages do not like you having a lot of debt relative to the cash you have or other underlying assets you have because it's risky. What if you go bankrupt? You end up screwing the brokerage. And brokerages do not like getting screwed. So this is where something special happens. Because you technically have this negative $80,000 loss, the broker might call you, because this is where the whole like why sell part comes up, right? And this, I want to make this very clear because I think this is often forgotten. Why would you sell? Sure, you're negative $80,000, but just wait. The stock could go back to $20, right? Maybe it'll go to $5, right? Why sell? Why not wait? Or maybe not sell. Why close your short position by buying the shares to cover? It's actually a buy to cover when you close your short positions. Gets a little tricky, but why would you do anything? Why not just wait? Well, the reason you don't wait is because the bank lent you 20, which is now worth $100,000 of debt. You've only got $20,000 of cash, and so when GameStop ends up going to the moon, you are liable for bringing that extra $80K in, and the bank issues a call, aka a margin call, to force you to buy to cover the shares. So looking at this right here, when you have this kind of imbalance, where all of a sudden your debt used to be 20K but went to 100K because the share price went so sky high, the broker's like, dude, either deposit money right now or we're selling all your other securities. Because oftentimes when people have these sort of margin balances outstanding, they might, for example, have other assets in the account too. Let's say you have 20K in cash, and just as an example, 80K of, I don't know, AT&T stock, right? Because AT&T stock doesn't go anywhere, it just sits there. So now the broker might say, look, either bring in an extra 100K right now, otherwise we are taking your 20K cash and we're taking your 80K AT&T shares and we are covering your debt right away because we don't want to lose any money. That's what happens when a margin call happens, is these bankers, or I shouldn't say bankers, these hedge funds, they get forced to cover these short positions. And this is something that creates a short squeeze, because when the margin call comes in, now all of a sudden these hedge funds get forced to cover their short positions. And what does that mean? They buy the GameStop shares at these newly elevated prices. Well, GameStop literally went from like $15, from as low as $3, honestly. It went from like $3 to $15 to $20 to $40 to $60 to over $100 to over $200 to now over $300. So obviously, given the situation I just explained, debt at some of those hedge funds could go to the roof so badly that you get margin called so fast and you end up needing a bailout. And that is exactly what happened. Because of margin calls, institutions like Melvin Capital, a GameStop short seller, has already reported that they took a $2.75 billion cash injection just to survive, and they have to give up future revenue to the company that came in to rescue them. Citron Research, a short seller, often purposefully mispronounced SHIT, Tron, has also had to get injections to stay afloat. Both Melvin Capital and Citron, as of Wednesday the 27th, have disclosed that they have closed all of their GameStop positions, which means they got big fat burned, like real bad burned. They were the dudes buying in mass quantities at $100, $200, and $300 a share. That money basically got transferred over to ordinary investors who were able to sell these shares at insane profits. This is absolutely incredible. And this is potentially a once-in-a-lifetime short squeeze, because GameStop was in this unique situation where an individual share was potentially lent out for shorting multiple times, leading the company to be over 130% short at one point. That means you got a whole fat setup for a short squeeze. And the craze has also led to people like Chamath, the legendary SPAC investor, founder of Social Capital, and a potential gubernatorial candidate for governor of California, to buy GameStop call options off Twitter recommendations from y'all tweeting Chamath. He has also since closed those positions at a $500,000 profit, which he is donating to, apparently, Barstool Sports. And Chamath also today on CNBC went to be the hero of the Wall Street Bets community by demanding and declaring that on CNBC, there is nothing that says what people on Wall Street Bets are doing is wrong. And there is nothing that says people can't have any kind of valuation metrics they want, or metrics set up, or projection, or thesis around a company. And the big takeaway from Chamath was, why is it that when big greedy hedge funds and suits end up shorting a company, that's okay. But when people get together and short squeeze those same hedge funds, that's potentially a problem? Now, CNBC, who held this interview and was definitely on the defense, argues that, well, no, we just don't want anybody to be left holding the bag. And the counter argument is, let grown people be grown people. If they want to invest in a certain way, there's nothing to say they should not do that. And this is despite a bunch of people on Wall Street kind of freaking out and going, oh my gosh, call Janet Yellen. Janet Yellen saying she's going to investigate. Call the SEC. SEC saying we're actively monitoring Wall Street Bets. To the point where Wall Street Bets, even at one point, literally shut down today. It went down for about 45 minutes to an hour. And the Wall Street Bets Discord server was also all of a sudden gone. Now, both of these issues ended up getting cleared up. They were both slightly unique issues. One was that Wall Street Bets was getting so much new popularity with user growth of over 1 million users in a very short period of time that they had to temporarily pause the Wall Street Bets service just to try to catch up and make sure they were still properly monitoring or managing and, monitoring content to make sure that inappropriate posts weren't being posted, that their algorithms are basically overwhelmed and they don't have the staff to keep up with all the new users. Discord ended up, Wall Street Bets Discord ended up getting banned because too many new users came in and were cursing too much, apparently, using Icelandic characters to get around the curse bot, which led Discord to declare the community as too toxic to remain on the Discord platform, and, well, Wall Street Bets Discord has been shut down. This, by the way, comes after Elon Musk tweeted GameStonks linked to the Wall Street Bets Reddit and mentioned that Discord was crazy last night. All in tweets, and definitely all to the help of Wall Street Bets gaining a lot of popularity and eyeballs. But now this is beginning to beg the question, is this legal? Is this okay? And what's next for this whole saga? I mean, technically, federal securities law prohibits anyone from participating in a market while at the same time misrepresenting a company to artificially inflate the value that security sells for. In English, you can't make stuff up about a company and use it to pump up a stock price. But Wall Street bettors argue that, hey, we're just sharing our commentary and opinions. Doesn't help that it's also hard to oftentimes identify who individuals are that are posting, given that most people post under various different names, such as Deep Effing Value or Roaring Kitty, which, by the way, those are the same user. That is the dude who turned $50,000 into over $47 million. Hats off. So now, legally, as long as people aren't misrepresenting GameStop's prospects or a stock's prospects, it seems hard to argue that people on websites like Wall Street Bets, the subreddit on Reddit, are actually doing anything different than what hedge funds do, or even active investors. For example, why is it that Cathie Wood can say, here's my thesis and price target for Tesla, I think it's going to the moon, basically, back when she originally said her thesis was a $7,000 per share price for Tesla before the stock split, and now the thing trades for basically over $4,000 a share, which is incredible. And she made that call back when Tesla was substantially cheaper. And this is exactly where people argue. There is no difference. So what if a bunch of people want to get together, share a thesis, and then execute trades related to theses? There's really no difference between active investors on Wall Street or investment funds and regular investors. They're just grouped together. And is it somehow illegal for them to be grouped together? Personally, I don't think so. I don't think there is anything wrong with Wall Street Bets, and I entirely support the Wall Street Bets community. But the big issue now is what's to come for GameStop. Because right now, some are arguing that GameStop specifically has turned into a little bit of a pyramid. That is, people are buying GameStop solely with the intention of trying to sell it to somebody else for more. But the issue is, at some point, you get to the top of the pyramid, where nobody's buying your shares anymore. Then, when you turn around to sell, it is possible you could get caught standing when the music stops in musical chairs, and unfortunately, there could be a situation in the future where nobody wants to buy the shares at these elevated prices anymore. And so, at the levels where AMC and GameStop are trading now, we have to realize that probably we're not going to see hedge funds buying unless they've been squeezed out through shorts, which so far they've already been squeezed out. Melvin Capital's out and Citron's out. So it makes us wonder, okay, how many other shorts are outstanding at this point? We know that hedge funds probably aren't buying and institutional investors probably aren't buying the stock for fundamental purposes at this level. So really what's left is a set of retail buyers who might continue to be willing to plow money into GameStop or AMC or some of the other highly shorted shares. And the issue that happens then is if retail investors start drying up or they run out of money, institutional investors aren't buying, what happens when some people start to sell, especially as you go from peak media attention to no longer peak media attention? After all, how much more peak media can you get than a shout out from Elon and Chamath, right? So this creates the absolute possibility that virtually overnight, we could lose a substantial buying pool for these shares. And when people go to sell their shares or their short-term call options, share prices might end up opening substantially lower than where we have seen them previously. And so this is where there's an important warning to anybody investing in the companies that are skyrocketing. It is okay to take profits and take some money off the Vegas table. Now, I am not advocating that you sell, but just remember what people say. You don't go bankrupt taking a profit, and you should not feel shameful of taking a profit. And even if that means taking a little bit of a profit, paying off some debt, or having some money to diversify, and then keeping the rest of your money in that investment. Ultimately, I don't want to take sides in saying you should buy or you should sell. It is ultimately your decision. But I also have a rule on my channel: don't sell. This, however, is one instance where I would say it is okay for you to sell a part of your investment. Now, what about the overall recommendation I have, and what does this talk about this silent market crash? What is this? Let's talk about that now. So, right now, think about this. At the same time as we have these meteoric rises at GameStop, AMC, BlackBerry, and some of these other companies, Fizz, and the other companies that are skyrocketing, we are seeing stocks sell off at the rest of the market. The Dow was down 2% today. The S&P fell over 2.5% today. The market was pretty red. Target, Starbucks, Amazon, Etsy, all of these companies were red, and some of them deep red. Enphase, deep red. Square, deep red. 7 to 8% sell-offs today. What's interesting is you have so much money plowing into these individual stocks like GameStop and AMC, at the same time as you have companies trying to help bail out their brotherly hedge funds because they're getting screwed and they need bailout money to cover their shorts. It's almost like there's this massive vortex that is these stocks like GameStop and AMC that are just vortexing money in. And at the same time they're vortexing money into these stocks, into that funnel, money is not going to the other rest of the stocks in the stock market. People are potentially even selling other positions to go buy into that vortex. It's literally sucking in money from everywhere. And in my opinion, this has the potential, especially if this continues, of creating a silent market crash, which means at the same time we see these stocks going to the moon, everything else slowly shaves off over and over and over again. And if we keep getting 4%, 5%, 5%, 6%, 6%, 7% losses, soon we're gonna have all of these stocks being on a 30% discount. And while the media and everybody is paying attention to GameStop and AMC, which I'm not saying is wrong, we should be paying attention to that, but at the same time, we are blind to the fact that a lot of the companies that we might want to buy and hold for the next 10 years, whether that's Enphase or Shift or Tattooed Chef or Tesla or Neo or Xpeng or Square or some of my other favorites, at the same time, we are turning a blind eye to opportunities there. And therefore, tomorrow, probably when the market opens, I will be going live with my course members to probably buy some long options, so some leap call options on some of these companies that are just literally beat down. I might buy options, I might buy the shares themselves. It's going to depend on volatility. We'll see what the pricing looks like. But the point is, it is entirely possible that while this vortex is going on, there could be a really big opportunity on the sidelines where the other stocks are that are just getting ignored right now. They're not getting attention and there's no money to even buy them. And so if you are an investor, consider keeping your eyes open to everything else that is going on. And for now, I highly encourage you to check out the birthday coupon down below for my amazing courses on building your wealth and joining me in my live streams. You will see that link and the birthday coupon code BDAY linked down below. Thank you so much for watching. Get your 4 free stocks with Robinhood, and folks, we'll see you in the next video.